the record has been pretty disastrous in terms of the scale and density of really, really bad behavior.
So this is part 2 of our cryptocurrency specials. In episode 1, we looked at what role cryptocurrency could play in your portfolio. So if you want to understand more about that, then just check it out. Today, we're talking to Joshua Oliver from the Financial Times, who's written a book called Hype Machine: How Greed, Fraud, and Free Money Crashed Crypto. The book looks at the biggest names in crypto, how Sam Bankman-Fried became one of the most famous CEOs in the whole world, and why the collapse of his company rippled through the industry. What does the recent history of crypto teach us about it today?
What is the basis for this as an asset? Do we really understand why it trades the way that it trades? And is the market manipulated?
I think it's important that we set out kind of our own personal interests here. So I own crypto. I've got it's about 5% of my overall portfolio. I see it as more like schmuck insurance, as I call it. I don't want to be there in 20 years and my son be like, why the hell didn't you buy the new thing? And I'll be like, well, I thought it might be a bit shady, but I quite like Bitcoin as an overall concept. Tremaine, go on. This guy's deep into it.
I worked at 2 crypto exchanges, and I run a crypto investment fund for like my friends and family. And I say it's probably about 80% of my portfolio, maybe 85.
So yeah, slightly bullish.
Slightly bullish.
Pretty bullish.
But it used to be a lot higher, but I'm slowly trying to bring it down a little bit to get a bit more balanced since I had a kid. But yeah, I'm about 85% currently.
So I'm 0%.
Yeah.
A lot of people will say, how could you possibly have written a book about crypto when you've never owned the stuff? But I see myself as always like an outside observer on the space. We were saying before the show, we can disagree agreeably about this. I'm not massively pro crypto. I've got a lot of problems with it, but I do think my view on this has always been like, it's like sex ed. You don't tell people just don't do it, because if people are curious, they will do it. And so it's good to give people information, and it's a free country. People can make up their own mind about what they want to do. But honestly, for me, it's like, I don't even want to take the risk of schmuck insurance. Like, I'm just going to be the schmuck. And in 10 years, people will be like, oh, you're totally left behind. But I've always been like the most careful, most conservative type of investor and person with my own money, just as a personality trait. That's kind of why I never got into crypto in the first place, to be honest, is because I was just like, I'm like a Vanguard life strategy guy rather than anything else.
Mm-hmm. Do you not see though that like, you have equity within a portfolio to introduce risk. Mm-hmm. And if there's a certain trade-off between risk and reward, that's worth having an exposure in your portfolio. And, with crypto, there's an potentially infinite upside. The downside is limited to 100% of whatever you put in. You could put in, say, like £1,000 and that might change your life. Do you not think that that's a risk worth taking?
I think for some people it could be. I'm not saying that like if you put crypto in your portfolio, that I think that that's something you shouldn't be allowed to do, or that you're a bad person, or even that you've made necessarily a bad decision, depending on how you've done it. But I think people should start the conversation from like, what does this do for me? And I think that's what you've done. You framed it the right way in terms of you've got a goal in mind, you're understanding the risk, you're limiting the risk, you're doing it in a smart way. But for me, I thought, what's the goal in mind? I don't really personally even have an investment portfolio where I'm looking to make that huge upside. I'm just trying to protect whatever wealth I have, maybe like have it grow ahead of inflation ideally, but not, I'm not trying to construct a portfolio where there is, that potential for upside, because I don't feel like I can devote the time and attention or have the inclination to do it well.
Okay, yeah. So the reason we brought you on, because you've written this great book and you've looked at, crypto and the side of it, the nefarious sides of it, basically.
Yeah.
You said that you went into this, with no preconception. Can you explain like your journey into writing the book and kind of?
Yeah, totally. Yeah. I think there are a lot of journalists who definitely kind of always thought crypto necessarily meant bad. And I've always been pretty skeptical about it, but I do think it's kind of crept into my life at various points over the years. And I think it keeps on creeping back in because some of the ideas that are involved in crypto are so cool. And I think that people it has this enduring appeal to lots of people who get curious about crypto because they're playing with really interesting ideas about the nature of money, the nature of assets, the future of money. And people have there's some smart concepts embedded in there.
Yeah.
Professionally speaking, my route into this is I covered like what we would say retail investing. So like DIY investing, what people are doing with their money, what your show is about. That was my brief at the FT. And so, along the way, I never only covered crypto. I was always, writing stories about funds and ETFs and what the market was doing more broadly. But then crypto just, at the period when I was writing about it, talking about like 2021 into 2022, just started getting bigger and bigger and bigger story. And from a news point of view, it just started to become, like the biggest story in that whole area of the market in terms of like what are people doing with their money as DIY investors. That was where retail flows were. That was where the interest and attention and the action was, and like the stories were completely wild. So that became like almost the entirety of my job for a period of time, particularly like the FTX collapse when the bankruptcy happened, and through kind of covering the unwinding of that. And then I went back to it in the fall to cover the trial. So I was in New York for the whole SPF trial, like in the courtroom every day, covering that. And you had the full courtroom where the actual trial was happening. And then, so to get into the main courtroom, people were getting there at like, you probably saw on Twitter and stuff, like 4:30, 5 o'clock in the morning, people were lining up to get into the main courtroom. And then there was a whole second courtroom full at times of people who were like watching on TV. So you had like another 200 people downstairs. It was like
the circus
mob
was incredible.
Scene. Yeah. But in terms of the book, you asked like, how did that happen? Through reporting on what happened at FTX, I just got asked out of the blue, if you ever thought about writing a book about this. And it actually wasn't like something that was on my like lifelong to-do list to write a book, but it's a great opportunity when it comes along. And there's lots of other great books about crypto right now. So it was thinking about like, what could I write that would be different from what someone else was going to write that people would want to read? And I tried to make this book like a good story, because the stories throughout all of crypto are really interesting. Like, people are interesting. Like, there's a human story here that's fascinating, but then also try and make it so that if you finish this book, you're going to sit down and feel like, okay, I understand a bit more about crypto as like an industry, as a concept than I did when I started. And, it is from my point of view. So it's like, it is a reasonably critical take on crypto, but I hope it's fair and, the evidence is in there for people can make up their own mind.
Can we start with then the basic understanding of like, how would you describe crypto?
Yeah. So I've been thinking about this, and like, I think one of the reasons people maybe find it confusing is that they sort of start with thinking about crypto from the tech and then building upwards. So people tend to start this conversation with like,
blockchain.
What is a blockchain? And then getting into all kinds of detail about proof of work and proof of stake and how does mining work, which is like quite confusing for a lot of people. And I think maybe a more intuitive place to start that actually leads you to a better understanding is like, what does crypto do for you? What is it as a product that might be of interest to you as a person or someone else? So like the way I would look at starting to understand what is crypto. So like asking the question, what is crypto for? And I think, you guys may have ideas to add to my list, but I think, some of the main things that we're talking about is like a payments use case. People have been talking about using crypto for payments. That's probably where it came from. Like the original idea of Bitcoin is like decentralized payment network. But there's been relatively slow uptake of crypto as a payment tool in the kind of like beyond a sort of fairly niche group of people. It's not like ever really become a mainstream way of using payments in the same way as Monzo or, Western Union or whatever. But you got a payments
cash.
Yeah, or even cash.
Dollars
Absolutely. Yeah. Dollars pretty good. It works pretty well. Cash is good. What else could people use crypto for? Speculation, or investment, depending on how you want to put it. Nothing wrong with that, right? Sometimes you got to, as you're saying, you got to take risk to get upside. And then, I think the final big use case at the moment would be just people who want to kind of store wealth, put money somewhere and hopefully also have it grow in the same way that you would put money in a bank and have it grow. That's like the goal for people.
Yeah,
you might buy gold. So, as a store value is the jargon. And then, some kind of, Bitcoin is one place people go for that, but it doesn't pay income. So you put your money in Bitcoin, you hope it will hold its value, but you're not actually getting like kind of an interest rate, as it were, on top of that. And then there's like, huge range of millions of different options out there in the crypto sphere for places you can put your money where you're going to get paid some kind of interest rate. Going back to the period that the book's about in the bubble, like, you could get interest rates where they were quoting you like 1,000% interest or something, where, you look at that, you're like, okay.
And they just called it tokenomics.
Yeah, that's a red flag by itself, right? It's just like, this doesn't make sense on this basic common sense sniff test. But, there is some, that's something else that people go to crypto looking for. It's like, can I store my, and actually I was looking at some stats on the way over, like, a survey research in the UK about what do people say is the reason that they are participating in crypto. And I thought it was interesting. I mean, it's one study, so there will be others, but the number one reason that people gave in the survey was as a kind of form of speculation or gambling. And so like people are quite clear about what they think they're doing, right? And I think it's interesting because it shows like the person who's buying crypto isn't being like, they're not stupid or clueless necessarily, like they know what they're doing, but it's so different from what crypto is being sold as. If you look at any of the advertising around crypto, people are always talking about it as kind of an alternative to financial services. And there are people who see it that way and participate for that reason. But I think I just found it really interesting to see that like the punter, like the person who is going in to do this in the majority is like, knows what they're doing. So, it's not, I don't think we should patronize people and say that people are only going into crypto because they're mistaken about what it does. People buy lottery tickets every day. That can be fine as long as it's being done in the proper
every street corner in the UK. And
I mean, this country, you guys are obsessed with gambling. Like I'm not from the UK, and I find it unusual, but whatever. I'm a visitor, of a guest. I'm not going to judge.
I mean, I don't like it, but like the prevalence of bookies in poorer areas is a direct correlation, right? And I think this is what a lot of people within crypto would probably be quite annoyed at, is the banks telling them like, we're not going to let you send money to that exchange because we don't think that you know what you're buying. And I think that patronizing tone has certainly not helped.
No, it really doesn't, because people legitimately think, well, up yours, who are you to tell me what to do? It's my money in my bank account. And if the activity is legal,
but you let me put it on Bet365 and spin it on roulette instantly.
Yeah, or CFDs, or lots of other things that you can do that money that are risky.
A lot of people like crypto for the fact that it's decentralized, so that if, for example, there's a war, the government can freeze your bank accounts, but they can't take your crypto if you have it on off the exchanges. So if you have it on a USB or a wallet, a ledger. So I think that's another benefit, that you have the ability to move money, transfer money internationally very quickly, and you can also completely own your crypto.
You can own the base layer, right?
Yeah. You can't own your, what's in your bank. They can freeze your accounts. They can't freeze your crypto
or if they can print it away.
Yeah.
Or they can devalue your.
Sometimes, I mean, so a couple of things to say there. And I think like all of what you said is true. But I think, a lot of the conversation with crypto gets muddled in terms of like conversations about what crypto is, how it's supposed to work, and how it often works in practice. And so like a main thrust, like if you ask me one sentence what my book is about, it's like, it's the gap between what crypto says it is and what it is. And so I think, all that is true in theory, but I think, a lot of cases people are using centralized providers for their deposits. And so then people just need to really understand what they're doing. And, if it's on like an exchange, then you're not getting that benefit of having, your complete control, of your asset. If it's not on an exchange or any kind of centralized provider, and you're doing the kind of your own wallet and running it for yourself, then just people need to understand the risk of you can just lose your money through a mistake that you might make. So I told a story in the book about this guy I know who's like senior exec he bounced through a bunch of different companies at the time I knew him, but he was like senior exec at various crypto companies. And he was someone who believed in it, and he kept, most of his personal wealth, in like a hardware wallet in his house. And he was leaving on vacation, and he like got in his car and he was driving with his family out the countryside, and it's like on the motorway, and it's like, oh shit, like it's that feeling like you forgot your passport, except he forgot his hardware wallet. So it's effectively like he left his bank account at home, and he had to like make a decision, right? What's he going to do? So he, ultimately, that's what I would have done too, turns the car around like 3 hours extra in the car to go get, this device, because he doesn't want to leave it at home in case house burns down, somebody breaks in, he'll want to carry it with him. And I think that I told that story in the book just to like highlight, it is a very difficult thing, for people to manage by themselves. And it's so unforgiving. Yeah. And so again, another reason why, like for me personally, in terms of, would I want to do that? It's like, I kind of know, like, I'm fairly organized. I like don't usually forget my passwords or whatever, but like, it happens. Yeah. And I think that sometimes people undervalue the kind of very old fashioned basic thing of just like, it's kind of useful that like, look, that house burns down and you run out into the street only in your underwear. Ultimately, it's a huge pain in the ass, but you can get there, right? You can get your ID back from the government. You can go to the bank. You can be like, I am myself. You can get your money back. And no matter what goes wrong, like, there should be a way that you can reconstruct your ownership through the intermediaries. The intermediaries are doing something for you. They're not just taking stuff from you.
No, but there is choice there, which is
Totally.
the point.
Yeah.
Like you can dial in that centralization as much as you want. Like people will say, oh, crypto's not decentralized because there's central players, BlackRock or whatever recently, but there's still that choice. There's still the ultimate
Totally.
choice of having it off exchange in your pocket.
And you could buy gold. I mean, people buy gold bars and silver. I had, when I was a kid, somebody like, I don't know, some aunt or uncle or some, I don't know, my parents gave me and my brothers like this little chunk of silver, and we had it like in the cupboard. It was the teeniest, tiniest thing, but it was like, here, like, this is your wealth. Put it under the mattress almost. People can always do that.
How much was that worth, do you think, that piece of gold or silver?
God, I have no idea. I was like, I don't know, 10.
So I would argue, though, that in the same space, you could put 10 trillion pounds worth of crypto, which is, I think that has a value. The ability to move large amounts and have reduced storage costs, because gold costs a lot to store.
Yeah, you know, it is a pain, you know, obviously to lug it around and to manage it. I think there's different cost benefit on, you know, because the other issue that I wanted to get to actually on the crypto thing with like Bitcoin, people used to say it was inflation hedge. It didn't work particularly effectively as an inflation hedge in the last cycle. You know, it's kind of, Bitcoin has had this kind of phenomenon, you know, where it's like reinvented people. Well, it hasn't reinvented itself because it's stayed the same. But people have reinvented what they think it's for.
NFTs, yeah.
And so I said, describing the book as like kind of a financial Rorschach test, you know, where you look at the blobs and you're like, what do you see? And it's like people look at the Bitcoin and they see different things. And there's a validity sometimes. I think there's aspects of validity to a lot of those. People are picking up on real features, which is why it's so like, Bitcoin just goes on. And like you would think after all the different things that have gone wrong in the crypto space, maybe crypto would just die. Like it doesn't, because there's something going on there. But I think, you know, if you were counting on it as an inflation hedge last time around, that would have let you down.
Short term.
Yeah.
It has done long term. Bitcoin, I'm talking here.
Yeah.
But Bitcoin has been a pretty good inflation hedge over the last 10 years.
But I think like in the key period where inflation really came into play over those 10 years, it was not doing really. I'm not disagreeing with you. I think it's about time scales. But.
Yeah, but like people want short-term solutions in investment vehicles. They're not going to get them. It's like saying the stock market's good for returns, but it isn't on any given day, right? Like, and I think, you know, anything should be viewed over a 10-year period, not on a day-to-day, because there's so much speculation that enters the markets that the prices become irrational across all asset classes, across property. Look at COVID and what happened to the property market. Where I lived, they doubled in value. That was complete speculation, irrational, emotion-driven upsurge in prices. So, you know, I think Bitcoin's a poor inflation hedge any given day. But over the last 10 years, I would say that Bitcoin's probably done what it said it would in terms of delivering a return that exceeded inflation. What is it, 40% on average a year?
I think the one thing that I would maybe just add on top of that is like, because of the reasonably short history that you're using for the analysis of Bitcoin, it's hard to draw very strong conclusions. I
can only judge it on what it's done over a time period.
Yeah. Can you guess what the biggest learning has been from doing this podcast or even my YouTube channel? It's that the most important investment you can make is in you. So for me, my path to real wealth isn't through investing, it's by building this business. And that's why I'm happy that we're working with Hostinger. Hostinger help entrepreneurs, freelancers, and side hustlers with their websites. My favorite thing is their AI website builder, which helps anyone create a professional website with zero coding experience. You just describe your goal in a couple of sentences, and the AI creates a beautiful looking website just like magic. You can then customize it, use the AI assistant to generate SEO-friendly text, and even use their AI logo maker. It's fast, user-friendly, and of course what I like the best is it's great value for money. You can get website hosting and a free domain from £2.99 a month. So if you want a website, then check out Hostinger, and if you use the code MAKINGMONEY, that's making money all one word, you'll get 10% off. And I've left the link in the description for you.
With inflation hedges, it's funny because it's all still linked to the fiat really, isn't it? The Bitcoin, it's still, the price is compared in dollars, it's priced in dollars. It's never going to be truly away from
that is such an interesting thing about,
it's like we compare it to a dollar.
About Bitcoin is like, I think if Bitcoin had fulfilled its original vision, you wouldn't talk about Bitcoin in terms of its price to the dollar.
No.
Because you would think of it as like, how many sandwiches can I buy with Bitcoin or whatever, you know, how many houses or whatever. But it's like, you when we quote stuff in our currency, it kind of shows you, I think, just from people's psychological point of view, like it's people voting with their feet, like what do I consider to be a real currency from a practical day-to-day point of view, a pound, a dollar, where I can value things, where I can transact. And so Bitcoin is like, it's definitely an asset because, you know, you can exchange it for value, but it's not currently, I think, being treated as a currency.
You're never going to detach it. Like people are saying, oh, it's the antidote to the dollar. But while you're still going, oh, it's worth $45,000. It's like the dollar is still the point of value.
Yeah. And I think the other thing that, it's important for me to say is like, my specialty is like what's actually happened. That's what I do. I'm not like a prognosticator, person who predicts the future. Journalists are terrible at that. Like, there's all kinds of hilarious examples of journalists writing about like, oh, this will never catch on.
The internet,
laptops, iPhones, like every single thing that has caught on.
Yeah.
It reminds me of like the FTX Super Bowl commercial that probably everyone has seen on YouTube. Larry David, where they're going through, and I feel like that was such effective marketing because it tapped into that underlying, like, all good marketing is based on a truth, right? Where it's like, yes, every time there's a big idea that comes along, a bunch of people are like, nah, it's never going to work. Oh, that's so stupid. And then it ends up, something ends up coming out of it. But so, there's no part of my business to predict the future of what's going to happen with crypto. I think the one thing that I would observe of like what's happened with crypto so far is that what we kind of describe as crypto has changed a lot in the period of time that it's existed. And these days, most of crypto is like really doesn't fit with the original vision that a lot of people have in their mind. And that's one of the big problems is like that gap between, a lot of the conversations I have about crypto end up being, one side of the argument is this is what crypto was supposed to be. And the other side of the argument is like, this is what crypto has been doing in the real world in recent years. And people are kind of talking past each other because of that. And if we could just recognize that like, the Bitcoin white paper was the beginning, but it's not still an accurate description of how, the system has evolved because stuff changes over time. And I think, the key point I'm thinking about here is just like the growth of centralized institutions within crypto as not the only, like there's still choice, like you said, but the main place that people are engaging, transacting, doing whatever activity they're doing is through, central institutions in crypto that are kind of companies that are controlled by people that have the same characteristics as other institutions and have the same fallibility. And that's really undermining, some of what people are trying to get out of crypto. They're kind of thinking, I want decentralization, but if you're engaging if you're engaging with, let's say in the past with FTX, you're not getting decentralization. You're getting an institution that's really fallible.
Yeah. So like centralized exchanges, something like FTX.
Yeah. Binance today, Coinbase, Kraken.
And it's basically somewhere you can go, give them your pounds or your dollars, your fiat, your currency, and you can buy cryptocurrency on the exchange.
They act as a middleman, like a bank, they act as a middleman.
Yeah. But you can store your crypto on that. You store it in your account.
They give access and security as part of like the arrangement.
Yeah, or a broker, like it could be your Robinhood or your whatever account you're using to trade. But
if they go down, then you lose everything. You lose your money. Which is what happened with FTX. My friend had all of his crypto in FTX and lost everything.
Which is terrible.
I mean, he'd already lost it before they went down. They'd spent it all. This is what people, it went down, I lost my money. No, you'd already lost the money and it collapsed when people realized all the money was gone, basically, because he'd spent it on political donations. And
so I think like the structure of that is super interesting. If you look at like, the very most straightforward explanation is like, people deposited into this institution thinking that it was kind of like a bank. And instead of keeping the money for them, they were just spending it. Like that's the one sentence version. The slightly more complicated version is you had like people putting real assets into the company in the form of like a lot of just dollars, but also like crypto that has value, like, your Bitcoins, Ethereums, things that, are worth something, were at the time and still are. And then that was going out again. Like the people who were in charge were just spending that money, were spending those assets. And then there was like this theoretical solvency.
FTT token.
That's propped up by FTT, Serum and Solana, but mostly FTT, which are like the Sam coins. And they're called Sam coins because they were just associated so closely with Sam Bankman-Fried personally that they were never going to do what collateral is supposed to do. Like collateral needs to be worth something at the moment that you need to sell it to avoid a loss. And that was never going to happen with like the token of the company that was, using it as collateral. So there was this weird kind of delusion inside the company where you could look at a spreadsheet of like a balance sheet, and they were like showing us all these spreadsheets of the trial, which is like, kind of crazy to see. Although actually, like in the FT, we had we had a leaked balance sheet quite early on as we were looking at this like spreadsheet and being like, whoa, this is not what this is supposed to look like. Where there's no real assets in this company. Like the dollars, like, very minimal, Bitcoin, very minimal, Ethereum, very minimal. Like those should be the three things that they have the most of because they owe those to the clients. And then what's making this company quote unquote solvent is FTT and, to a lesser extent, Serum and Solana. And like in trial, it was interesting to see like prosecutors trying to point out to the jury that like, this makes no freaking sense. Like this, you know, Sam is smart enough to know that he can't be counting these things as if they make him solvent, because he knows like the nature of those assets. And you can't sell them, because if you start to sell them in any significant size, you're going to tank the market. So, you know, the analogy given in the book is like, if you have a notebook, like my notebook, 100 pages, and you write $1 on each page, and you sell the first page for $1, and then you put the rest of these as an asset on your books of worth $99, like that is not a valid accounting practice. That's a ridiculous thing to do, because if you start trying to sell the rest of your pieces of paper that have $1 written on them, no one's going to buy them. So they're not really worth like what they were being counted as being worth. And so that was, I guess, like to some extent, maybe it doesn't matter. Like, you know, they could have just stolen the money and not pretended that they weren't bankrupt, but that was like a kind of a crypto twist on the classic fraud of you could present this fiction of we're a solvent company because they were using this token that they themselves invented.
Fake like purchases of stocks. He was just like manipulating the paperwork to make it look like
totally. And that, you know, they could have done that. They could have just written, you know, we have more dollars than we actually have on their balance sheet. So in a weird way, they were like kind of trying to like somewhat report, I don't want to say accurately, but like, I don't know. It's a funny, like none of this stuff is new, right? As you pointed out, Bernie Madoff, like, you know, crypto just continues trends from traditional finance. And I think that's totally important to recognize.
20s, 30s, 40s, it's all that playbook. That's why people are like, oh, it's such a scam. Like they literally just copying the finance playbook before it was regulated.
Yeah. And I think that cuts both ways in the sort of like, you know, I think I don't want to be so simplistic as saying like the pro and anti crypto argument, but it does cut both ways. It's like, on the one hand, you know, you have the whataboutism of like, look at traditional finance, it's a total mess. Like, so why are you coming after crypto and being so down on crypto? On the other hand, like crypto is not escaping from some of those same problems. It's just replicating them and actually kind of going back in time and doing the same stuff again that we did before in traditional finance. And then that got cleaned up. So there's a little bit of a back to the future element to some of these scams, is what you're pointing out, right?
How do you separate them bad actors versus bad tech? Because like what you're pointing out here is like people that have just preyed on an unregulated industry, which is, you know,
I don't know. Is there such a thing as bad tech? Like, I don't know. Yeah.
What I mean is like, is it a crypto problem or is it a dickhead problem? Do you know what I mean?
I'm not sure they could be so easily separated. I mean, one crypto thing that contributes to the dickhead problem or creates opportunities for the dickheads is this ability to kind of very easily create very portable assets. So the analogy that I use in the book is like, if you went back, you know, before the kind of internet revolution, then the people who were able to publish information was a very small set of institutions. People like me who work at big newspapers, you know, book publishers, TV stations, movies, but it was like big companies kind of controlled the mechanism of publishing. And then you went through the internet and now everybody can publish. Like you guys can have a podcast in a kitchen. You can like literally just go on Twitter, whatever. So you had like the democratization of publishing. And I think part of what you're seeing in crypto is the technology has facilitated very easy asset creation that like with relatively straightforward technical skills and watch a few YouTube videos, you know, not going to take you very long to be able to like get a quick, you know, ERC token out there and brand it however you want and sell it to people. So you have like this ability to have asset creation that's not controlled through big banks and like, you know, try and get something listed on the stock market, right? You know, you got to get a bank to sponsor you. You got to like hire millions of lawyers. You got to get thousands and thousands of pages of stuff together.
So a SPAC.
Yeah, you could do SPAC. But even a SPAC is like, by comparison to crypto, like a SPAC is like really hard work, you know, but
to be honest, when I worked at crypto exchanges, you can make a token in a couple of hours.
Yeah,
so I can make T and Demo coin and then
you keep pushing this T and Demo coin.
It's subliminal meshing. Eventually you're going to say T.
This is denominated in pasties.
This is your retirement plan.
It's my, leverage Demo, get his face on the coin, me and him. But people would just pay, we could pay an exchange to put our token on the exchange, but you can't pay the FTSE can you put our stock on the FTSE, but you can pay today to get your token on the exchange and then everyone can buy it.
100%.
So,
And so I think that is like a feature of the tech, is a result of or a usage of the tech, you know, that emerges from the tech that does make it easier to do this kind of dodgy stuff because you can do pump and dumps, like just spin up these random tokens and hire celebrities to shill them and then, you know, dump on people. You can do more sophisticated, you know, Sam Bankman-Fried style stuff where you like, you know, you borrow, you print assets, you know, endow them with some sort of kind of speculative value that people will briefly accept in the market and then borrow against them. And so you're like levering yourself up based on fake collateral. So there's different ways that basically, if you just kind of scrap all the guardrails around what institutions and what controls are placed around creating assets, it does, I think, it's, create an opportunity for the dickheads to have a field day, frankly.
And how much of it do you think is like people going into it with the intention of scamming, and how much of it do you think is like egos where the situation gets bigger than them very quickly?
Yeah, such an interesting question. I mean, I've been thinking about this for like, a very long time now. And it's really tough because like this is the hardest part. The only honest answer is like, if you're talking about Sam Bankman-Fried particularly.
Or
like,
SafeMoon as an example, as a massive scam where they look like kids. They don't look like very sophisticated guys.
At the end of the day, the only honest answer is we don't know because you can't go inside someone's head, but you can look at how they behaved. I think like it's rare to see a situation where people like start out at the beginning and write fraud at the top of the whiteboard and are like, okay, so should we do telemarketing or shall we do...
how we're going to do it, guys.
We're going to do... We got the options, crypto, telemarketing, whatever, like, and then they pick, okay, crypto. So like, it's not like they were sitting around at the Alameda house in Berkeley, California in 2017 being like, yeah, it's definitely going to be crypto. Like those like, annoying text scam messages are like really, from the 90s, or I guess there weren't texts in the 90s, were there? But anyway, I'll leave that. But so, there's always a little bit of both, I think. And like these things do kind of overtake people and they find themselves trapped and they double down and it gets worse and worse and worse. And eventually it falls apart. I think you see that in almost all these big fraud cases, some element of that. But like there was really pretty deep dishonesty at now. If you look at the evidence, there's like pretty deep dishonesty from the FTX Alameda crew for quite a long time. And I think it started out in an area where if they were being dishonest, like kind of didn't matter. Like if you, at the point where they, it does matter to an extent, but it matters a lot less. Like by the point where they're a relatively obscure company with relatively little money in the kind of really wild west of crypto, like, yes, they may be being dishonest. They may even be breaking the law, but it's just like, you're never going to get caught. Like you're not even in the top, 300 of the dodgiest people in crypto at that point because you're low on the priority list. And when you become the biggest name in crypto, not the biggest company, but the biggest name for sure, and then it all goes wrong, like you're absolutely going to get hammered because, the justice system does to some extent respond to the kind of public attention and the politics of it. And like, especially in the US.
The tallest poppy in the field.
Yeah.
Like they cut the head off that one.
Totally. And it's like they were definitely the victims of their own success to the extent of their fame, where because it was so famous.
He positioned himself like that, though.
Yeah.
Like,
he did.
Effective altruism. Totally. I'm a legend of a billionaire was like so sickly to look at now in the context of what he was doing.
And you set it up. And then, because you built yourself up on a pedestal, when you do fall, like you're just going to get totally destroyed, which is what you've seen happen. And, that fair enough.
I think a lot of, like Damon said, a lot of these crypto tokens or companies or the dodgy players, sometimes they grow so quickly overnight. They might go to bed and they've got, we're trading at like $1 or like 20.002. And then they wake up and it's worth $1 and they're like, holy crap. And then
now got 200 million.
And then everyone else jumps in there. Oh, this just did like 1,000x overnight. So then everyone else jumps in and it just gets snowballs into a bigger, more and more money. Then eventually they're like, let's just run with the money or let's do a rug pull or maybe that might not have been their intention initially. But then I think it grows so quickly in crypto overnight. People are made millionaires. Yeah. People lose money overnight, like their life savings. So I think the snowball effect also sometimes they're like, well, we've got 5 million in the account. Let's just go. Totally. We never thought we'd see this much money in our lives.
And the temptation is
the greed takes over.
The greed takes over. But also if it's like, we've promised people this product that we have no idea how to make. Suddenly they've given us all this money. We're pretty sure we don't know how to make the product. So if we keep going, we're probably going to lose all this money again. Everyone's going to hate us, or we could just bail with the money and everyone's still going to hate us, but at least we get to keep the money.
I've seen that happen a lot.
Yeah. But the other thing you get also is like the other side of the exact same dynamic is like these things escalate in value really, really quickly and then become huge targets for hacking. And that, you see that the tech and the security and the level of resources that are devoted to it is just not kept up with the amount of money that's like
big weaknesses in the tech. And they can just take the money.
Relying on, so I think, in looking at FTX, one of the things that's interesting is like, if you just hypothetically as like a thought experiment, if you just bracket the fraud, like which we now know it's convicted it was fraud. But if you just take that out of your mind for a second and just think about the company otherwise, all the stuff that we've learned about it, in many ways, it just wasn't set up properly to run as a company that had that much money in it. It was not set up as a grown-up financial institution, and there was like people were too inexperienced. There weren't the proper controls, wasn't the proper staff. It was too small in terms of number of staff for the amount of money they had. And so I think there's this whole other set of issues that like the fraud is more important, which is why people are focused on it. But it's interesting to just think about, like, you had this company that was totally overwhelmed by the amount of money that was suddenly, I think that like the weight of all this money is suddenly in this really rickety kind of structure of a startup that just can't cope. And so the whole thing blows apart. Like, say what you want about the big banks. Like, there is a structure in place where you can't just literally, when like I deposit $5 at HSBC, that like the teller just spends it. Like, they've gotten pretty good at those systems where they're like, okay, they do other things wrong and bad. There's lots of scandals, but it's like, normally you're not just like spending the customer's money out the back door, because there's systems that no one person can do that, right? Whereas at FTX, it was like, if Sam and, a few other people around him got together and were like, we're going to take the money, it wasn't stopped. There was no system to catch that or flag it or stop it, prevent it in any way. There wasn't like the safeguards around it.
So why did it convince everyone? If it was such a bad business, there was so much fraud, why did VC like love it? Why did retail love it? Why?
Yeah, I don't think it's, I think it's it wouldn't be fair on retail to expect them to like, penetrate that. No, people are judging from the information that they see publicly.
If it's being advertised at the Super Bowl, it must be legit.
Like, or even, honestly, give people credit. Like, if Sequoia and BlackRock and everybody else are investing in it, it must be legit. I've always felt like that was probably the key thing. There's lots of different elements, because it's like, it really does teach you a lot about like how kind of trust and validation works in society, that like the more people associate their identity and their brand kind of with an institution or person, it just gives them this veneer, or like this aura of trustworthiness. And you're like, when you start to look at this person, all these celebrities associated with them, all these big name investors, they're being taken seriously by politicians. You're like, okay, well, somebody somewhere must have checked.
Yeah.
Right. And I think, but they hadn't. And that's the problem. I think of all the people who were in that position, the people you would have expected to do the best checking would be the VCs, right? Or and the other investors. They weren't all strictly speaking VCs, but it was a VC style investment. Like, those are the people who you would have expected to do it properly and really dig into the details. Like, it is a hard thing to catch. I don't think that fully excuses them, but I think, the VC market at that time was also suffering from, a lot of the overhyped characteristics that you saw in other parts of the market. And like,
you got like WeWork and places.
Yeah, and they never learn their lessons, right? They keep on doing this. Theranos and this cult of personality around founders, and like this obsession that like, you'd always have to find the next Bill Gates, next Mark Zuckerberg, next Elon Musk, and like looking for that particular template, such as the literal opposite of diversity, because it's like one particular stereotype that they're looking for. But then also, like, at that time, you have all kinds of different market conditions, like you're in the COVID market. So interest rates are very low. It's very hard to get that return. So this does affect professional investors, behavior. There's just a massive amount of money going into VC at that period of time. Some of the best fundraising years ever. Probably, I think maybe it was the best, but I can't remember off the top of my head. And so then you have that downward pressure of money that wants to be spent. And, VCs have the same idea about schmuck insurance that you have from from your portfolio, where they're like, if I don't have a crypto company somewhere in my mix, and then it turns out the crypto is the next big thing, all my investors are going to come to me as the VC and be like, you're a schmuck. Yeah. You missed it. Your job is to catch these trends before they leave, before they go. And so the mindset of VC is very much, you can fiddle the numbers. Back 20 companies, 2 will succeed. Back 100 companies, 5 will succeed, whatever, but that's kind of the idea. And they just generally don't worry about the ones that don't succeed, because that's part of the model. I think what FTX and some of the other examples like, Theranos and have shown is like, there are the ones that don't succeed, and then there are the ones that like blow up into spectacular, massive fraud cases. And, that is a bad look for the VCs. And, I just think that their system, it's obvious that the system is not set up to really take a deep dive and look for fraud. The one thing I would say is, there definitely are some investors, and some that I spoke to, who did look at it and say no, right? And people who had the opportunity to maybe try and get into FTX and said no. In that environment, the company, the startup, has a lot of power, because there's so many VCs chasing after them. They're like the hottest company in the hottest space. Everyone wants to write them a check. And so they can kind of run the table and dictate the terms. And so what did FTX do, right? They had none of the investors had a significant ownership stake. They all had like little percents, which meant that they had less control as individuals. It also allowed FTX to justify there being no proper board. So then, they're not giving board seats to the VCs, so that someone's like really there kind of on top of it, like looking into the details. And also they could kind of dictate what transparency they were going to give through the investment process, where if people asked questions that they didn't want to answer, they could just be like, well, nuts to you. I've got these other 100 people lined up around the block who also have the same size of checkbook and are going to write me a check, no questions asked. So why would I deal with?
Chamath said that.
Yeah, you asking
I know he's a bit scammy himself, but he said he called up and said, I want to see the numbers. They literally said, go fuck yourself. He said he hung up the phone and thought, maybe they have got a money printing machine over there. Because
or not.
The level of we don't give a crap was so high that it kind of convinced people they must have something, because no one would act like that normally.
And I don't know about Chamath, but there are other people that, I spoke to for the book who had sort of similar stories. So it definitely seemed like this is a thing that happened, where if you weren't willing to do the deal on their terms, they did not have to deal with you. Yeah. There's so much money they could get. And I think, it is a bit of, but more than a bit, it's a seriously bad look for VC as a sector, where you're there's just so much FOMOing going on. And it's kind of 10-year-olds on a football pitch, they're all chasing one ball, they're all following the ball and not playing their positions. And you're it just seems as though the level of rigor was definitely not there. The thing that's interesting is people say on the internet, the tweet is they didn't do their due diligence. But I think it's obvious they didn't do enough due diligence. That's self-explanatory, but they actually did do some. And that's kind of the weird thing about it. It's there was some degree of looking into it, just not asking remotely the right questions in enough detail to actually find the thing that they needed to find.
What kind of estimate, or would you say, is the amount of businesses that are kind of on the rotten side of the distribution? I
mean, in the period that I was writing about, if you look at it not by number of companies, but kind of by their market share, I would say a large number of the biggest ones who controlled a lot of the market share had some of those serious underlying problems around being offshore, not being properly regulated, not being transparent about ownership or structure, or, basically being, relatively speaking, unaccountable, kind of freewheeling, even at Binance, for example, describing themselves as the pirate ship, and they taking advantage of that, floating around different islands, not being under the control of particular jurisdiction. So a lot of the market was operating through those types of exchanges for a period of time. Relatively speaking, now the trend has been those more offshore companies are losing out compared to some of the more regulated onshore types of players, because of, first of all, you've got demise, companies like FTX just going away because they've gone bankrupt. And then also regulation and enforcement catching up with some of the stuff that was going on during the kind of bubble period. And I think also just, people sitting around looking at the example of what happened during that time and thinking, I'd rather be doing my business with, more reputable type of player in the crypto industry.
So we've talked about bad actors there a bit as well. I want to move on to some of the changes recently and how that informs your opinion on the space since the book, in a way. Mm-hmm. So there's two that stand out. There's Coinbase, who I think everyone focuses on the bad exchanges. Coinbase, they're not perfect, but show me a finance institution that is. But they've been a constant in the space that hasn't gone down, that hasn't betrayed trust. So the reason I pick up on Coinbase in particular is, they're US based. They've become the major custodian for a lot of the ETFs. So a lot of the, what I mean by that is they're the ones that are literally holding the Bitcoin, right? So I think BlackRock, etc., these massive institutions have said Coinbase are the people that we're going to hold the Bitcoin with. So they just seem to me to be very different to the rest. Even Binance, which was the biggest, wasn't it? Shady in terms of based in the Cayman Islands or wherever, and they seem to be an example of a smooth operator in that sense. And then there's the recent SEC filing to approve the spot ETFs and the impact that has on the space. Do you think there is legitimate players, and do you think there is a legitimate space for crypto as a result?
I mean, I think there's definitely a possibility of a legitimate space for crypto. I think that there are still, even with the ETF and the exchanges that have done fine, there are still kind of issues, I guess, broader issues about, what is the basis for this as an asset? Do we really understand why it trades the way that it trades? And is the market manipulated? And the issues in Bitcoin about, very large holders who have a lot of sway over the market, I think some of the things that still make me uncomfortable about it. I think there are some intermediary institutions that are more credible and better supervised. But there's also a lot that aren't still, so people need to be careful about that. you got to have, there are still tons of different options that are available to people to participate in crypto through intermediaries and middlemen and institutions that are no good, and people should be really careful about. Just the fact of having like an ETF box to put around crypto is like somewhat, to me, neither here or there. Like, it definitely helps in terms of like a route to access that is probably a little bit more reliable than some of the others if it's being done by more credible institutions with better supervision.
Just so for anyone listening, can you just explain, what are the differences between this ETF with Bitcoin, the spot ETF versus, say, the futures one that came out a couple of years ago?
Yeah, so a very high level, a futures ETF is a derivative contract. Basically, what you own is a contract that is based on the price of the asset. So, there's more complexity there. And the thing that people have been hammering on the door of the SEC for is like, what they want is an ETF where like the ETF owns Bitcoin and you own a share of the ETF. So you own a share of the Bitcoin that underlies that, and it's direct. So it's not intermediated through a futures market.
You're not betting on the price. You're owning the asset.
Yeah, you're owning the thing. And so like, there's, people have been trying their best to make the derivatives based ETF do the job, but I think people just wanted the more direct, more straightforward, product, and that, finally arrived. But at the same time, it's like, it doesn't answer the question of should I access crypto? You still have to make that decision based on all the, the information that's available to people. They can make up their own mind, but, just having the box, like the ETF is only ever a box for the thing that it kind of is used to access. So it's,
but it's like saying, should you buy Tesla?
Yeah,
I watched the SEC announcement and I kind of got the vibe that they did it reluctantly. They didn't really seem like, oh, we love this thing. It's more like
everyone definitely seems to think
the cat's out of the box. There's so many goddamn Americans that have got this thing. we need to regulate it because we can't just wipe 50 million people out, basically.
Yeah, and
but they still approved it.
Yeah, I think there is definitely a feeling that it was reluctant. Sometimes regulators do have their hands forced, and you have this kind of like back and forth of like, once something achieves a certain amount of popularity, you can't put it back in the box, and or you can't get rid of it. So you've got to try and get on top of it. But I think there's further to go before I would say like, I totally feel as though, it's been completely legitimized. And there's the Bitcoin is one area, but then if you look at kind of the rest of the world of, the tokenverse and like all the millions of different options that you have, are the standards the same in terms of like transparency, in terms of disclosure, and like people getting good information the way that, obviously it's not perfect, but you get much more information, much more reliable information about a stock than you do about a token, because of the nature of the regulations around the market, and people can make better decisions. Just also about we haven't talked about yet, the offshore companies issue, because this comes up definitely with FTX and lots of other players. Binance, for example. Yeah. So, like the UK does have rules in place about investments, financial promotions, crypto derivatives. You're not allowed in the UK for retail investors most of the time. And, you could disagree with that rule, but it is the rule's been made by a legitimate process in the UK. And I do think like big picture, it's problematic when you have companies that are based in kind of, random islands offshore and are using the nature of crypto and the nature of the internet to offer services into a jurisdiction like the UK without being subject to or overseen by, the legitimate authorities in this country or whatever country you are. Like we wouldn't normally be comfortable with like, an offshore for-profit company that is basically just ignoring the consumer protection rules in our own jurisdiction because they can get away with it for a period of time using crypto and the internet. I think that is a problematic phenomenon. So like, if there's rules, it should be fair.
Or whatever they're called for Chinese share ownership, because that's an offshore structure based out of a shady island.
What's an ADR?
Well, I don't know if
I'm going to press the button.
Yeah.
Yes.
What are they even called? I don't know why it slipped my mind, but you don't own Chinese companies. You own a derivative that's based off an island off America. So any Chinese own, and then they list on the US stock market, right? So you're owning a derivative there that's not actual ownership. And China could turn around and say, we don't recognize any of those at the minute. And we basically work on a relationship of, they're not going to say that because they don't want to piss America off.
Yeah, people need to be aware of that risk. But I think that the phenomenon there is different. Like, using an offshore jurisdiction for a kind of workaround like you're describing is one thing. What I'm talking about is like a company as was, in the history of, for example, Binance or, other companies in the space.
American
FTX,
Depository
right?
Receipt.
There you go.
Nice.
FTX, right? Down in the Bahamas, offering their, services in many jurisdictions around the world, ostensibly not including the US because the derivatives rules in the US really kind of stick. And people are afraid of pissing off the US government. But basically, depending, there are people who would argue they're trying to follow the rules in different countries. But, basically, these companies are like, a lot of the time not. They're just, they're allowing people to navigate. You go on the internet in the UK and you can access this website and trade in something in a way that is not under, the rules that would normally be in place in the UK if you were dealing with a UK institution. The other problem with that is you have no recourse, right? So again, like another thing to think about if you're making the investment is like, what do I do if this goes wrong, right? What do I do if these people make off with my money? There are ways to complain about financial institutions in the UK. They're independent government agencies that can look into your complaint, can help you out, can make a decision, can enforce on the company, can require it to give you your money back. And all that kind of stuff is like positive consumer protection that certain like generally is much more lacking in crypto. In the past was almost completely absent. I think it's, it's getting there, but like that's a development that I think you would want to see. And I think people should think about their, if, they're thinking about what intermediaries they're using. It's good to use one where you have someone, there's some you can appeal to somebody and say, hey, they haven't treated me fairly, and like, get some actual justice there.
Yeah. So do you think then that these regulators entering the space will ultimately provide that?
Well, never perfectly, because, like none of these systems are perfect and never have been. And I think, it is part of this conversation where you're like, there's a million examples you can point to in the history of banks or traditional finance writ large of like incredibly scandalous behavior that isn't properly looked into, that isn't properly enforced.
2008.
Yeah,
there's no recourse on all of that.
Yeah,
like the bailouts.
Totally. And so it's like, the system is, it's worse than not perfect. Like it's often, there are really, really bad examples. And, but I think that, doesn't necessarily, there's a bit of a whataboutism in crypto where people are like, oh, what about this in TradFi? What about that in TradFi? My challenge would be show that crypto is better, and look at the evidence of how crypto has worked in the real world and consider whether it's better. I would argue it hasn't been so far. And like, if people want to try and convince me personally about crypto, you need to see that track record of things improving, because so far, like, the record has been pretty disastrous in terms of the scale and density of really, really bad behavior in this industry. Like as a percentage, it's just like, way off the charts compared to TradFi.
So people talk about the crypto bubble. Is that something we should be talking about?
I mean, I'm obliged to say yes because I've written a whole book about it. But it's like, I mean, there is obviously a definitional question of like, how do you know you're in a bubble, right? And crypto makes that question harder because it's like, well, how do you know what it's supposed to be worth? So it's just like, I feel like, a common sense definition of the bubble would be when the market price, like what people are willing to pay for it, is just like way out of whack with what you would think the real price should be, and the things have just gone, sky high in a short period of time for no apparent reason. And it's all based on just emotion, sentiment, good vibes, FOMO, et cetera, et cetera. And so like, there are probably economics professors who would give you like a very technical definition of a bubble. I think, with the recent crypto one, you kind of, pretty much know when you see it. I think like, especially in terms of how quickly it came down, it's like, well, what was it being supported by if it could crash that fast? I think most people would say, even if they're relatively pro crypto, that like things had gotten overheated and out of control for a period of time. And, it all went a bit crazy and the prices were, had risen too fast for not for the right reasons. And so then it all had to come back and check. And that's, that happens in all markets. It's not a crypto phenomenon. It's a, markets phenomenon since there were markets. This is, people, it should be on the like list of banned crypto cliches, but if people will start talking about tulips, right? People talking about tulips in the comments or like, the South Sea bubble or all these like big historical canonical bubbles. So it's not like, you can't blame crypto for the phenomenon of bubbles. But it does seem to be like most people accept this market is very cyclical to the point of, it depends on how you want to phrase it. Like either it's very cyclical or it goes through bubble and bust cycles. Mostly a decision of rhetoric, right? And I think, in terms of, it seems more likely than not that characteristic is going to continue, that crypto will continue to be a kind of boom and bust, so to use more neutral words, you would say boom and bust rather than, bubble and crash. But,
I like cyclical.
Take your pick.
Cyclical, because it's kind of, it follows that pattern up, down, up, down.
Or maybe it follows the halving, which is then by design, right?
Yes.
You limit supply every 4 years and there's a steady increase in demand you're going to see. And then what happens is there's FOMO around those points.
Do you think that the halving sounds like it should be like something in a dystopian horror movie?
Definitely.
And it's like every second person gets
welcome to the purge.
The halving. It's like, oh my God, the halving is coming. It's just a spooky characteristic.
I think everyone in crypto, like not in crypto, everyone who's been in crypto for a while or who knows the market, understands it, the people that work in crypto, let's say, they expect the market to go crazy and to crash. But then the people who are kind of retail investors who are looking from the outside and reading all these JP Morgan articles and BlackRock articles and FUD and all this new stuff, they're like, I can't believe it's gone down 80%. But everyone who's in crypto is like, we expected it to go down 80%. Or we expected it to go up. So like for me, I think it's cyclical and I expect it to go down and go up. But a lot of people, I feel they get emotional and they're like, oh, it's gone up loads. Let me buy some. And then the next thing that's happened is about to crash. So you got in at the wrong time.
It's just retail behavior.
You're right, because you're right to an extent, like almost take your pick, walk up to any sort of person who's involved in crypto at random and be like, is crypto going to like be boom and bust? Does it go through cycles? Everyone would be like, yeah, totally. And I think at the period when it was sky high, you would have been like, is there going to be a crash or a correction? People have been like, yeah. But then you did also see like, supposedly a lot of the like most sophisticated, smartest people at the top of the crypto industry acting as if the price would never go down. And that's the kind of the crazy thing. It's just like Sam Bankman-Fried is supposed to be like galaxy brain genius of all time. And like, what was Alameda doing? To quote Caroline Ellison, they were like balls long crypto. And, it's just like a leveraged long bet on number go up with no hedges that ended exactly the way you would expect it to end. So it's like, there's this weird disjuncture, right? Where you're like, yes, everybody would tell you. And if you'd asked, like, I probably did, I don't even know. I probably did at some point ask Sam to his face during like the hype period, like, isn't there going to be a correction? And he'd be like, yeah. But somehow that didn't translate to the behavior.
I did this. Loads of my friends did exactly the same thing. We're like, it's definitely going to crash, but we're not going to sell right now. We're going to buy more. We're not going to hedge.
So it's tough. It's really tough to like actually.
He needed the price to go up though, didn't he? Because he'd spent all the money, right?
Yeah, no, totally. But he didn't have to put himself in a position where he needed the price to go up. That was
But that's
the
like
crazy
the human behavior that you can't. But that's like the idiocy, the dickheadishness of his actions, right? Like,
but I think to a lesser or greater extent, people are prone to make that mistake, and it's like it highlights it, but because of the craziness of the FTX story itself. But it's like when you're in that super like bullish period, is the time to have a voice in the back. It can be my voice in the back of your head, being like, it's going to come down, and don't just think that. Like actually take steps, and it's like somehow adjust yourself and think about it. Like, what would it really think about? What would happen to me? What would it be like for me if this went down? If the answer is like, all of this profit is just come from, I only ever put $1,000 in the beginning or whatever I could afford, £100 at the beginning. And all of the theoretical net worth that I have is just been generated by that £100. And if it went away, I'd be no worse off than when I started. Then that could be okay. You could just sit there. But it's like, make sure that's true and not, it's really seductive and easy for you to slip into a position where it actually would affect your life if there was a crash. And you really don't want to be in that position because everybody knows it's like an up and down type of market.
I mean, all markets seem to be a bit more like that now.
But it's obviously an exaggerated scale.
But even the stock market has its wild swings.
Totally. And so, again, people, go back to all the like regular markets advice where you've got to have
it's the cognitive biases everyone has.
Yeah. You've got to have your like, reserve. You don't want to have everything in the market. Like, you just got to acknowledge that it's, it's that line that the FCA makes them put on all the adverts, right? Like investments can go up as well as down. It's like, yes, that's really true. There's a reason why they have to say it on every single advert.
Yeah. Yeah, like if you look at the inflows on like famous funds like Peter Lynch or even like ARK, which is like, the innovation ETF by Cathie Wood, it had this like amazing run of like 184% in a year. All of the money that went into that fund went in at the end of that year because not many people bought the fund prior to that. And then the fund tanked. So the average investor in that fund lost money. Peter Lynch, I think, is the same. It's like it compounded on average 20% or 30% a year, but the average investor lost money because they were selling when the fund was going down and buying when it was going up. Yeah. And that's just human nature. And that's not a crypto problem. That's a human problem, right? Problem, it's just more exacerbated. And I think if someone's looking at going, should I buy crypto? Ask yourself, are you buying it because your mates are all going, bloody hell, crypto's going crazy? Or are you buying it because you've got a sensible, like wider portfolio diversification in mind?
And the other thing I would say on like questions to ask yourself when you're buying crypto is just this soundbite that it used to be the thing everybody said, maybe I hear a little bit less now. It's like people will be like, oh, you do your own research. And it's kind of this get out of jail free card for the crypto industry to be like, buy this thing.
Not
it's going to pump, it's going to advise. Not financial advice, do your own research. And you're like, okay.
After doing a video on YouTube for 20 minutes saying how it's going to go sky high.
You can't just disclaimer your way out of it. And I think also like when people are being told to do their own research, like ask yourself really honestly, can I get the information that I need to make the decision? Not because I'm saying that the person is stupid and they can't figure it out, but like, is the information available or is it secret and not being disclosed? And if you can't get the information to satisfy yourself, I think there is always that danger that you kind of, you do your best to get the information, you get what you can get, you think, okay, now I've done my research and so I can invest. But actually you just have not got the actual information that you need to make a good decision. And at that point, you have to make the hard decision and walk away. Like if in doubt, and if you feel like it's, you're just not getting the transparency, then you should just walk away. That's not the moment to invest, because that do your own research thing has just been this like constant cheat in the crypto industry that I think, leads people to have a false sense of confidence that you can somehow check this out and it's all on the individual. Sometimes information is just not available, or, it's not being disclosed, or you don't actually, if you need to, like, I'm not someone who could go in and read the code and assess whether this smart contract is designed the way it's supposed to be, because I don't have the technical skills to do that. If that's what's required to do your own research on that particular investment, I should always walk away, I think. Unless you have a really trusted, independent third party with no economic incentive who can give you good advice. In terms of an investment, like if you're trying to come up with an investment thesis for your crypto, it's like, make sure that the thing that you're investing in is actually connected to what you believe in. Because people will be like, if for example, they see, UK is going to embrace CBDCs and someone goes out and buys Bitcoin, like that is not, maybe there's going to be a little bump because other people are making the same connection in their mind, but it's not like a good investment thesis to have. It just doesn't make any sense.
My thesis is diversification. I buy a global index because I'm unsure, what will perform. So if I buy that, then I should broadly diversify into what is an emerging asset class. And, it's scarce. It is scarce, like mathematically. And, like there's limited supply, and the supply reduces over time. So I'm like,
you're making this hard for me, man, because you seem to have come up with the most reasonable possible. You're like the perfect crypto investor, the most reasonable possible philosophy, and I think it can be fine. Like I said at the top, it's a free country. People should make up their own mind. It's not my position to judge them or tell them what to do. But it's just what I'm trying to throw in is just like, be really careful, because the history of it so far,
100%.
A lot of stuff has gone wrong, and watch for just a lot. There's a lot of like basic risks that people should continue to watch for.
Do you think you write a follow-up book in 10 years?
We'll see.
I'd be like,
I'm all in on Bitcoin.
How I was wrong about crypto by Josh Oliver. Yeah, definitely. Yeah.
With quotes from Damo and T.
Yeah, being like, man, he's
sponsored by Damo and T coin.
No, stop with his pasty coin. No, my whole point is like around investing is I don't know what's going to happen. I don't buy individual companies in great quantities because I don't know, and like I think it's hard to beat the market. And if I'm broadly diversified, that will capture a lot of stuff that won't work, but it will capture the few things that will. And that's, like you said before about if you're pinning all your hopes on crypto, that's probably a bad thing. I think the same thing about investing. I think a lot of people discover investing, discover compound interest and think, oh God, like this is the thing that will make me happy in 30 years. And then my miserable day-to-day existence will be better because I'll have £1 million and I'll just hammer everything into this. That's the wrong way to look at it. It's like you said before, all I'm doing is compounding the wealth that I generate in my day-to-day life. Yeah. So, from those that's the viewpoint I view this all from. Yeah. And a little bit of exposure to crypto, 5% that might go parabolic or it might die. That's okay. 80% like this guy. That's
it was 100% when we started this podcast.
I don't back 80%.
No. You don't co-sign the 80%?
No.
I can't get a little snippet for Instagram. No. We think 80%.
No.
We're going to clip you up so it's like all in crypto.
85%.
Yeah. 100. Yeah. There you go. Now you've got the sound.
Oh, we got the 100 sorted.
We got the 100 now.
We'll do the work from there.
Yeah. Thank you for watching. If you want a summary of the episode, you can sign up to our newsletter, which is linked in the description below.
And if you enjoyed this episode, trust me, you'll love this one.